Welcome back to the Bitcoin Layer. I'm Nick Bhatia, joined by my research associate, Demian Schatt. Before we hit record, I almost didn't do so. Demian has a lot of rates questions for me, and I wanted to do them offline, but instead, I figured that we'd just hit record anyway because it's going to add value to somebody out there. Demian and I are working on a lot of things at TBL. We're building out our chart pack for TBL Pro subscribers. They can join at thebitcoinlayer.com/subscribe. We're just trying to make our product better. And Demian is becoming more and more a part of our research process. So he and I are spending more time on the phone doing rates calls and Fed discussion and Fed watching and just overall macro analysis. So today he had a bunch of questions for me, and I wanted to do more of a informal thing, Demian, but let's just go for it because I think people will benefit. But it is you and me going to be working on some of our products themselves and how we're thinking about charts. So as you're asking me, I'm going to be, trying to deliver some information to you so that when you go and start working on the chart pack today, you have some extra tools and maybe you have some extra inspiration for additional charts. So I'll turn it over to you.
Thank you, Nick. That all sounds terrific. Well, yesterday the Fed just wrapped up its meeting and no cuts. They kept citing that there was a lot of uncertainty. And in every episode we do, whether it's about Bitcoin or the Treasury market or bond volatility, everything seems to trace back to the Fed. So I just want to understand more about how the Fed works. That seems to be at the root of everything. When the Fed does change rates, what is physically happening in the system?
Yeah, it's a good question. The Fed has always been a lagging indicator to us. And the reason that the Fed is a lagging indicator is because the Treasury market, meaning the market rate for money that is longer than overnight or 3 months in nature, but money that is promised to you 2 years from now, money that is promised to you 5 years from now, those specific numbers, the 2-year yield out to the 5-year yield, that is the market for money. And when we think about money markets, those are instruments inside 12 months, including overnights. And that's what the Fed, quote unquote, controls. They control the overnight portion of the curve. But at all times, the overnight portion of the curve and the 2-year point of the curve are being compared to each other in terms of which one is better value. Remember how we discussed that example of 2-year yields being at 3.9 and overnights being at 4.25. But if you feel like overnights are going to be at 3% in a year, 3.9 is something that you want to lock down today, right? Because going forward, well, what about starting in 1 year? You're going to be getting 3% on your money every night, but you could have had 3.9% being accrued if you had locked it in when 2-year yields were there. So it's always a relative game, Demian. That's what the yield curve is all about. It's about what if the rate follows the path that the market expects versus following the path that I expect it to follow. And in that way, I can make a judgment if I want to own 2 years or if I want to own overnights. Because if you don't think they're going to cut, let's say, for example, you do not think they're going to cut, why would you buy 2s at 3.9? You wouldn't. You would just roll overnight at 4.25 because you don't think they're going to cut. So it's an expression of what you think is going to happen, whether or not you're going to buy 2s. So that is what we need to think about for the 2-year part of the curve. The Fed has proven that they are reactive to where the money market in the 2-year part of the curve points them toward. However, and this is a big however, the Fed is a political institution with a political mandate, which is to control inflation and to control unemployment. right? And then the secret third mandate, not so secret third mandate of financial stability, right? They don't want markets to panic. And so for you can actually relate that to the unemployment side of the game, because if they see a market panic, it can turn quickly into a recession, which can turn quickly into people getting fired. So when they intervene in a financial market panic, they're able to explain it by saying, hey, we're just trying to prevent unemployment in the future, right? Because if we let this scenario continue to play out into a crisis, millions of people will lose their job, and we'll be up against it in terms of having to cut interest rates a lot. So let's get ahead of it now. Bitcoin isn't just a balance sheet asset, it's the benchmark. On May 14th at 11 a.m. Central, Unchained and Strive are hosting a live online event. Every business will buy Bitcoin. The discussion will explore why capital allocation is being redefined through a Bitcoin lens, how performance looks different when measured in sound money, and why building a Bitcoin treasury is becoming a strategic imperative. Make sure you RSVP today at unchained.com/TBL. The Financial Freedom Report is a free weekly newsletter from the Human Rights Foundation that tracks authoritarian regimes and how they are weaponizing money against people, and how Bitcoin is acting as a solution. A one-of-a-kind newsletter connecting the dots between financial repression, geopolitics, and emerging technology. Find the link in our show notes and subscribe to their free newsletter today. Do not write your seed phrase down on paper. This is why we use Stampseed, a DIY kit that enables you to hammer your seed words into a durable plate of titanium that uses professional stamping tools. These titanium plates are heat resistant up to 3,000 degrees, rust proof, crush proof, and time proof. Go to stampseed.com today and use code TBL for 15% off of your order. What is the Fed doing, Demian? The Fed is doing their political job. No, we're gonna take off the tinfoil hat and just describe what the mainstream understands the Fed to be doing, right? Which is fulfilling their political charter, which is to maintain the currency of the United States. And then legislated over time, they have been charged with controlling inflation and unemployment, or doing their best to counteract disturbances in both of those things. And they're supposed to be independent in that the Fed cannot be told what to do by the president or the Treasury Department or even Congress. We appoint a Fed chair, and then the Fed is in charge of what they're doing. Now, when I was first understanding what the Fed is, I understood it to be a banking institution. Because it's independent and because the president and Congress can't tell it what to do, what it is a banking institution. Okay, now we have to think back to my book, Bitcoin Age, in which I build up the credit system and its existence and its takeover of the country and the dollar itself. It's banks that issue the credit. So it's banks that suffer if credit contracts. It's banks that suffer if deflation hits the system. Because if deflation hits the system, then existing debts are harder to pay off. There will be defaults and banks will have to contract in size. And so I want to mention Larry Lepard's new book, The Big Print, which I just finished yesterday. Larry is arguing, and for people that might not have read it, I recommend you go read it. It's an excellent history of American finance. And it's a very opinionated book in that Larry is arguing for sound money. And this is at the center of the Bitcoin debate. And Demian, I know I'm going off a little bit, but all of this is really, really important for the viewer to understand also when we're talking about the Fed and trying to understand what the Fed is doing. You asked me what the Fed is doing and how the Fed, what impact the Fed actually has. But the correct question is, who is the Fed acting on behalf of? That is the correct question. So now to Larry Lepard's book. And I commend Larry for writing this book because it is a strongly opinionated book that we need sound money. In my own research line, I haven't taken exactly that path in terms of what I want to write about. Because I actually am a bond trader and I come from this world of the credit system. I don't see it going away. And so my goal is to describe it and teach it to people. And Larry is arguing that actually that whole system itself needs to go back to more of a sound money standard. He also points out periods in history that have been deflationary and good for the economy. And that is what I want to focus on and why I brought up his book today. Larry points out a point from history in which we had deflation and positive economic growth. But what I'm describing in Bitcoin, and by the way, this is pre-Bitcoin age history, which in chapters 2, 4, and 6, I really start at the Fed and go from there, 1913 and beyond. But Larry's pointing out a period in history before 1913 that this happened. So what is the story that I tell in my book? It's that whenever credit contracts and you get deflation, the banks come in and say, hey, we have to find a way to re-inflate the system, grow credit. And the gold standard inhibited that, right? Because you can't just create more gold. And if you're anchored to gold, even if it's fractional, and you want to create new credit, you can only create as much credit as is reserved by the amount of gold you have in your vault, or gold on reserve, or gold certificates, etc. If that is the standard, then you cannot expand. And that's why they got rid of, and by they, I mean the banks, got rid of the gold standard. Because they knew that they couldn't expand without it. So I am living in a different world than Larry is writing his book from that perspective, because I am observing the credit system and saying, hey, I believe it's going to keep going because they've already gotten off a sound money standard for the last 50 to 100 years, depending on how you want to start it in 1931 or 1933 or 1968 or 1971. However you want to classify it in history. There are a bunch of arguments for each one of those dates. It doesn't matter because we're not on a sound money standard anymore. Larry is arguing, bring it back. And that's why people really love this book right now. Because he's taking a stance. Bring it back. Now, it's not the book that I wrote or that I would have written because, again, like I'm coming from a different perspective, right? I'm not trying to argue for bring it back. I'm actually trying to say, hey, I don't think it's going away, but we have Bitcoin and it's a tool that you can use in this current system. And Larry is saying, hey, Bitcoin is a tool that we can use to change the system. To change the system. And so we need all walks of life. This is why I wanted to talk about his book for a little bit, especially because it's fresh in my mind. I just finished it yesterday. Now, let's get back to your question, which is what the Fed is doing. Demian, the Fed is only doing one thing, really. They're trying to make sure that we don't get a deflation and that we don't get crazy inflation. That's it. That's really all they're trying to do. Now, the Treasury curve, when it goes up and down in yield, remember, that's just the market telling you where they think they need to be compensated for inflation. That's it. That's all interest rates are. It's all compensation. So if you lock it in for 2 years or lock it in for 10 years, you are telling the market this is what I need to be compensated for this time horizon. And the compensation is based off of their view of inflation. That's it. You can almost throw unemployment out because it's really their unemployment, whether it leads or lags inflation, it's all just part of the same credit cycle now. Where if we get a deflation, then you're going to get joblessness. They're like one and the same. So they're trying to prevent against too much deflation, and they're trying to prevent against too much inflation. And that's why you have the 2% target. It is, and the 2% target, which becomes 3 over time, or, as it's becoming 3 over time, it appears, really eats away at people's savings, right? And if you're not actively investing, then let's say that the average person is keeping their money in a 0%, yielding environment, they're getting stolen from, right? That's the inflation is theft narrative. It's true. Inflation is theft, especially if you're not going out and rolling treasury bills or playing the yield curve and trying to lock in yields based off of where you think inflation is going to be. Do you see how ridiculous it is to try to expect the public to play the yield curve to outpace inflation?
Of course.
And that is why this is a system that works against people. So in that way, Larry and I are describing the exact same thing in our book, in our books, in our respective books, right? He's saying, hey, look at this system. It's really unfair. It works against people. I am also identifying that, right? So their intent is very similar too, which, but their paths and their conclusions are quite different. So I want to give people that perspective on both of these things. So now you add in what's going on in the economy today with a little bit of a growth scare, but the Fed really not knowing if it's a true growth scare or if it's not. The Fed also doesn't really know if the business cycle is ending, right? Because we have this classic school of thought, which is that we are supposed to have a business cycle. Now, Michael Howell has shown us over the last few years that the credit cycle and actually the rolling over of debt itself is the driver of financial markets. The liquidity available to roll debt forward. And that honestly dispels a lot of the need for a business cycle analysis. But not so fast, right? I think it's important that we think about the business cycle. And the business cycle says that, hey, when the Fed hikes rates to slow down inflation, they should be slowing down the economy too when they do that. And so are we getting a business cycle? Now, I will mention the corporate bond market. This is an insanely long rant answer to your question, Demian, but we're going with it. This is, by the way, guys, this is how our market calls go. He asks me one question, I talk for 45 minutes. Now, on the other side of, hey, we should be long in the tooth in a business cycle, and maybe we should have a slowing economy and companies that are firing people and trying to scale, make efficient operations. We've been tracking the labor data. You're looking at JOLTS and following it every month for us. You see where the job listings are, where the quit rate is. Those things are telling us different things. But I watch the corporate bond market. And the corporate bond market is, now it goes back to the Michael Howell thesis, which is that it's all about rolling the debt. As long as you can roll the debt, everything is good. And so that's why the business cycle, I used to teach it like this, but the business cycle, it isn't the way that I teach it anymore. It is the ability to roll debt, because what happens, I've done an entire episode on this in the past. What happens when the corporate bond market is strong? It means that the corporation is able to bring in cash It's able to pay off existing debt, which it does with some of the money. Then it's able to buy back its shares, which reduces the share count, which increases earnings per share. Just mathematically speaking, it increases earnings per share because you buy shares back and retire them. And then by increasing your share price, you are easing your own financial condition because you can use that share price and offer warrants, stock options to future employees, bring in people, resources, by issuing them equity or future equity. So your stock price is your own financial condition. You see that, Demian, as your stock price goes up, you become more powerful because you can print your own money, which is, hey, I promise you a share in the future. And the employee says, wow, that's worth XYZ amount of dollars. I'll take it. But if the stock price wasn't so high, then that number wouldn't be so high, right? So it gives them the ability to print money for themselves. So they bring in resources, they can grow, they can build new products. The corporate bond market strength itself is a tell. It's extremely high signal. And I'm very blessed to have worked opposite the street for many years. And I'm blessed to have kept very strong relationships with the street. And so you know, Demian, that I get notes from the street every day to my inbox. And I get to read what the street is doing. And I get notes on the corporate bond market every single day. And I don't bore the viewers and readers with all of them. Most of it I don't. But I look every day. And what I'm reading in the last few weeks, very strong corporate bond market. Issuance every day. Big deals happening. And so where is the slowdown in the business cycle due to high interest rates and corporates not being able to borrow and low liquidity, meaning them not being able to roll their debt over? Right? Liquidity means somebody has to lend the money, right? Because when you remember that our liquidity metric is asset side liquidity. So asset side liquidity means, can you buy the bond? Can you add the bond to your balance sheet? That's what a liquidity provider is. That is what we need to be thinking about more than the business cycle. So now get back to the Fed. What is the Fed seeing? The Fed's seeing everything is fine. That's it. They're seeing everything is fine. They're seeing the corporate bond market is strong. And they don't see, now you can put your political hat on, political meaning left versus right now. Now you can see maybe that they don't want to accommodate Trump any more than they have to. And so for all of those reasons, there's no reason for them to act. But the rates market is telling them that they need to get rates into the threes. From their perspective, Demian, what is the risk if they cut? The risk to them if they cut is that inflation picks back up. Right? Inflation is already above their target. Now, we've been looking at trueflation trending below 2%, but from the Fed's perspective, it's still a little bit too high. There's a jump in inflation expectations by survey, not really by market metrics, but by survey. There's a big jump in inflation expectation due to the trade war. Some of that might be politically motivated. It's coming out in terms of who they are surveying for those University of Michigan inflation sentiment indicators. But the risk to the Fed of cutting is inflation coming back. So they can't take that risk. What is the risk of them holding rates here? The risk of them holding rates here is that maybe a few more people get fired, and they're not being accommodative enough for all the businesses in the country. But if they keep them here for too long and too many people get fired, then they'll worry about deflation again. And this comes down to, what are they really doing? Who are they acting on behalf of? They're acting on behalf of banks to try to make sure inflation doesn't go low. And making sure that inflation doesn't go too high is how they accommodate the citizenry, honestly. They're only going to keep their job if they raise rates if inflation gets to 9%, right? You understand that if they don't raise rates during 2022, you basically are going to have a revolt against the institution. Hey, inflation went to 9%, you didn't do anything. No, we raised rates to 5.5%. We're trying to help you. We're trying to help you, right? And so that's how they keep their job. And then when inflation goes too low, the banks call and say, hey, you got to cut rates because we might start getting defaults here. It's looking bad for us. So you got the people on one side and the banks on the other. And that's maybe the short answer to your question. The Fed has a lot of stakeholders. It has banks that are, and that's literally how the institution was set up, Demian. They had the New York Fed, which was the bank's central bank, and then you had the Board of Governors, which are appointed by Congress and the President of the United States. So you do have, from the agency theory side, you have banks and you have the people, the electorate. And they both have a claim on the Fed. So did I answer your question?
Yes. And also some of the other questions. But why 2%? Who came up with this 2% inflation number?
Yeah, that's a very, very good question, and you're getting to the core of the problem here, Demian. You're getting to the core of the problem, which is that the 2% inflation target is a product of academia that is a reverse justification for being on this fiat credit standard. Now, the 2% target, Demian, the reason why it's so important to think about the question that you asked, which is why do we have it? The reason that question is so important is because it really demonstrates why banks have such an outsized influence on the world. That this 2% inflation target, it's almost a religious existence. And who are we to question that religion? And I do have a line in my book in which I say maybe Bitcoin allows us as a society to question. I don't say the 2% inflation target, but that's basically what I'm saying. Maybe Bitcoin helps us question the very existence of why we need this system that targets 2% inflation. And that is also why I brought up Larry's book to start this episode, to show people that the 2% inflation targeting has been given to us by them. It's not something that the electorate has asked for. And it's something that the electorate is increasingly questioning. Like you just did with me. Why do we need it? So hold on to that question and keep asking it to yourself philosophically as you come across it. It's part of your job now as a Bitcoiner and as a member of TBL to philosophically question the 2% inflation narrative from every single angle that you can. So I commend you for the question. I can't really answer it holistically because it's one of the holy grails of our entire financial approach. The why. And when people buy Bitcoin, they're actually voting against that. I don't want your 2% inflation currency. I'm going to save it. I don't want to have to play the yield curve. That's what Bitcoin is. I don't want to have to play the yield curve to outperform inflation. It's obscene. It's absurd. It's actually an absurd premise. And that's why sound money is such a pure concept. It resonates with people. Like, why do people enjoy these books about the Bitcoin standard, or like Larry's book, The Big Print? Because it resonates with them that they shouldn't have to be subject to a fiat standard. Because if we really understand it, it's absurd. So I'll let you get to your next question.
Well, I want to go back to what you were saying earlier about you think, the credit system's here to stay, and then Bitcoin is a tool now that everyone has access to. But wouldn't Bitcoin hurt the credit system because people aren't using dollars anymore?
So the dollar system is the financing mechanism for activity, in my vision. It's not the transactional currency, and it's definitely not the financing currency. So just think about, we don't have to get into the Eurodollar system today because let's just not do it. So let's do it onshore. Okay? So let's imagine that a company in Arizona has a factory and they need crude oil as their input to power that factory. Okay? Well, let's just say they need diesel fuel. Okay? And the diesel fuel is being refined in Texas, and the oil is being mined in Texas. And so the Arizona company needs to purchase diesel from a Texas company. Okay? Let's call it $10 million. Now, in a Bitcoin world, let's say, Bitcoin is eating the dollar system in this environment. The Texan company says, we will only accept Bitcoin for this transaction. We will only accept Bitcoin for this transaction. The Arizona company says, well, we don't have $10 million. We don't have it in dollars. We don't have it in Bitcoin because we need the diesel to fire up the factory to make the products to then sell them for money so that we can make 20 million and pay you off 10 million and pay some of our other suppliers off and then have a profit. That's how business works. You don't necessarily have the capital to power the factory. You borrow the money, you power up the factory, you sell the stuff, you pay the loan back, and you keep the profit. That's how the world works. So the Texan company says to the Arizona company, I only accept Bitcoin. Arizona company says, well, I don't have Bitcoin. And they say, well, borrow it. And they say, okay, but the rate is 17% or something. We can't afford that. They'll say, well, then borrow it in dollars, buy Bitcoin, and send it to us. So they go to the bank. The bank says, you need $10 million. What do you need it for? They're like, I'm going to buy Bitcoin with it. They're like, I'm not going to lend you the money. And then they say, oh, never mind. I need to buy diesel fuel. I'm going to use it to buy diesel fuel so that I can power my factory and build products and then sell them so I can make money and pay you back. And then they say, okay, that's an energy loan for your business or a business loan, and secured against your factory. So do you see how, and by the way, that loan is new money that's created. The bank didn't have it in the first place, right? Remember, when we create a loan, we're creating the deposits. So they create deposits out of thin air and grow the financial system. So the financial system just got bigger because an Arizona company wanted to build stuff and buy energy from Texas. In a Bitcoin standard, the amount of money in the system does not increase. And so that deal might not get done. So actual capital and business formation and growth highly depends on the dollar system to grow, because that's how credit is created. Now, I'll give you another example. When, let's say let's say that the Arizona company has profits for many years and starts buying Treasury bills as its, as savings for its checking account, basically, is rolling Treasury bills. And all of a sudden they say, hey, we want to build a new wing of the factory. And I have the money. Actually, I have it all in Treasury bills. I got like $5 million in Treasury bills. And so I want to sell those bills for cash and spend the money to build a factory or to increase the size of my factory. So they take the $5 million in Treasury bills, they sell it to their bank, and the bank credits them with a $5 million deposit that they can spend. Now, the bank that created that deposit, the bank didn't even need the $5 million, because they can add the Treasury bill to their balance sheet and just grow their balance sheet because it's a good asset. So they just create money for the Arizona company to build a new wing of their factory just because the company had Treasury bills. So the bank making a market for treasuries itself and providing liquidity to that market is all done by credit creation, new deposits. So why I don't believe that Bitcoin buries the dollar system over the next 10 to 20 years are these reasons. It's hard for me to see. Of course, nobody can see the future. I don't see in the next 5 to 10 years how the dollar system goes away and this financing currency goes away. I don't see how the Arizona company and the Texas company are able to do business in a Bitcoin standard that doesn't involve dollar lending. I don't see that. So it might happen in the future, but I'm being just honest with myself when I say I can't see that far into the future. The world has to evolve in a way for that to happen. And I like to see Bitcoin adoption, but I don't see Bitcoin being used in onshore financing transactions today. I don't even see one. So how am I going to see the whole system go to it? Right? I don't even see one. What do I see? I see people allocating to Bitcoin for long-term savings positions, like gold, right? As a new generational gold type of asset. And we had a whole credit system, evolve over 600 years. That's the story I told in Layered Money. 600-year evolution of a credit money system alongside gold. So how does Bitcoin just make the credit system collapse or go away and get back onto a pure Bitcoin standard? You see, that's not my thesis, Demian. It's that it exists as a reserve asset, but doesn't evolve as a financing currency, or at least that's not the way I see it playing out over the next several years.
Mm-hmm. Isn't there a tremendous amount of built-in risk with the credit system because we keep rolling over debt, but what if something goes wrong and then someone can't pay off debt and then there's like a ripple domino effect of that?
It's not even a what if. We have a financial crisis in 2023. We had one in 2020. We had one in 2007, 8, and 9. We had one in Europe between 2011 and 2013. We almost had one in 2015 with the Chinese deval. And we almost had one in April of 2025 after Liberation Day. You almost had one, but it just ended up not happening. And you didn't need the Fed to intervene that time, which is interesting and something that we've observed. So it's not a what if. They're happening and they're becoming more frequent. The 2007 to 2009 was the first sign. I shouldn't even say the first sign. The first sign was the LTCM crisis several years before that, long-term capital management. And I will recommend to you, Demian, and everybody out there to read one of the most important books, I believe, in modern financial history, about modern financial history, which is called When Genius Failed, about LTCM. If you want to know what are the risks were well known 25 years ago with the failure of LTCM. They played out again in 2007, and they played out again in 2020. We got Silicon Valley in 2023 that went under, created another financial crisis. The Fed had to intervene right away. So we already know, Demian, it's unstable. It requires continual and even greater sized Fed bailouts. We've been talking a lot about QT. Like, is QT really relevant when, if in 2 years they need to double the balance sheet again? And we were arguing about whether they're going to decrease it by 15 billion or 25 billion or 5 billion, every month. But then in 2 years, they're going to increase it by another 4 trillion, which is quite possible if we get another financial crisis, right? So, your first question was about what the Fed is doing. Well, what they're really doing is just praying that we don't get another financial crisis. That's really what they're doing. They're praying that they don't, because if they do encounter one, they know they have to expand the balance sheet again a lot and accommodate a lot. So that's what everyone's waiting for, really, and they're watching for. What's what we're watching for too. Right now, I know it's one of your questions, like how do we watch for trouble? It's repo rates. Yeah, if repo rates start trending up, it's not accommodated enough, and they need to lower rates or stop decreasing the balance sheet, increase the amount of reserves in the system. So that's what we're watching for. So far, we haven't seen anything that says, hey, we're up against a financial crisis. Little spikes in SOFR here and there are happening, but I mean, that's also why they didn't cut yesterday. They don't see it. They don't see anything so dangerous. And we watch repo, and right now we're not seeing anything dangerous either.
You said financial crises are becoming more and more frequent. Doesn't that suggest that there is an issue with our system and bring up an argument for a sound money system? Are we just supposed to accept that this is the way the economy works?
That's a fantastic question. And you have to see how, Demian, how radical Trump appears to be for the center and the left. Yet he's not saying that we need to end the Fed. He's saying we want to fire Powell, but neither he or Scott Bessent are saying that we need to end the Fed. So do you see how it's nowhere near either side of the political spectrum? It's a fringe view. I'm not saying it's wrong. It's something that we've studied for years. I've written 2 books about Bitcoin and how the system is highly unstable, right? So it's not that it's not known. It's just that politically it's a fringe view. But we have to own it. We have to own it on the fringe that it's a fringe view. So you can argue that, hey, financial crises are getting more frequent, and that's a reason we should be considering an alternative way. But the public, when they respond with, this is a political agenda, did you hear Trump campaign on we need to end the Fed? No, he basically said we need to question what they're doing. Now, can end the Fed enter the lexicon over the next 4 years? I actually completely believe that, yes, it can. So hold on to that view. You explain it, you flesh it out, you write about it. People have been doing Ron Paul wrote a book called End the Fed 20 years ago. And many Bitcoiners are familiar with this book. It's not an unorthodox view, it's just fringe. And just like a strategic Bitcoin reserve was fringe 1 year ago. But now it's already signed into, I shouldn't say law, but it's been signed into effect through the executive branch. And ending the Fed or altering the charter of the Fed itself would be a monumental task that would need, it would need Congress. It would need both sides of Congress. So maybe you can just see how far away we are from it politically. But that doesn't mean that it's a view that doesn't need to be spoken about, thought about, and we'll continue to flesh it out. With Demian Schatt, I'm Nick Bhatia. Thank you guys for tuning in today and for this rant, a little bit of a rant and education session as we get down into the nitty-gritty of rates and Bitcoin and how we think about this new asset class. We'll catch you guys next time.